Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
Welcome back for another episode of Opto Sessions. Today I'm talking to Chris Camillo, founder of Dumb Money and an investor that's turned $20,000 into over $30 million and counting. Having led and founded a series of successful tech and software companies, in 2018 Chris and his two friends Dave Hanson and Jordan McLain gave up the day job to invest their own money full-time. Not only have they already recorded extraordinary success, Chris & Co have pioneered a unique investment strategy, or what they call social arbitrage. Chris hasn't stopped there. Dumb Money have chronicled every high and low on their eponymous YouTube channel, now a mainstay among individual investors and of course their 52,000 subscribers. Chris gives us a real insight into his strategy, but not only that, he identifies the advantages enjoyed by those managing their own investment portfolios up against the financial might of institutional money managers. A breath of fresh air. So, without further ado, enjoy the episode. Hello and welcome, Chris. Great to have you on the podcast. How's your week been so far? Has it been busy?
It's been great. It's been busy like every week this year, pretty much, with the pandemic and market volatility. It's been pretty nonstop for me.
Yeah, great. Yeah, similar on our side as well. So I wanted to start by addressing something that I think will be at the top of anyone's agenda that's in your YouTube channel, Dumb Money. And that's the fact that you've turned $20,000 into $10 million. In fact, I believe that's the subject of one of your most watched videos on the channel, so people should definitely check that out. But a lot of what I want to talk to you about today is digging into how exactly you did this. And I watched your talk at the Bazinga Trading Summit last year. You described how it'd be difficult or even impossible to explain that strategy in just 8 minutes. Now today we've got a little bit longer than that, so we'll go into it in more detail shortly. But to start, I wondered if you could give us a top line about how the strategy works and crucially perhaps what makes it different.
Yeah, so I call the strategy, and this has evolved over the years, but I guess I've coined a name for it now, and it's called social arb investing. There was a point in time when I called it information arb investing. That was pre the social world, right? Maybe 12, 13 years ago. But now that we have Facebook, Instagram, TikTok, Twitter, and the whole world communicates online, it's evolved into what I call social arb strategy. And it's actually really simple. It's not fundamental investing. So it's not about, looking at company financials or identifying companies that are misvalued based on revenue or, price to earnings ratios. It's not looking at management teams. It's not looking at company health. It's certainly not technical investing. Not looking at price or history of price movement for the equity or any other variables like that. The methodology relies exclusively on one's ability to detect change quicker than others. So what you're really looking to do is to identify some sort of change that's happening in the world that could relate to a change in consumer behavior. It could relate to a change in culture. Really, quite honestly, a change in anything. A change in maybe it's a product trend or a government regulation. And then you're attempting to connect that change to investable opportunities in the market, right? So either companies or sectors or the market as a whole that would likely be impacted by that change once others are able to either identify it like you have or fully appreciate what you've seen in terms of that change. So I like to think of it as investing when there's an imbalance of information, and that's when you enter a trade, and then exiting the trade at the point of, information equilibrium, right? When everyone kind of appreciates that information at the same level. So that's really what social arb investing is about. And more often than not, these days, I'm identifying that change through social channels by seeing an acceleration or observing an acceleration in conversation around a particular topic that would be abnormal based on the normal conversation, level of conversation about that topic, right? So it could be something as simple as identifying that a product is selling out in the market, or that, people are, really adopting connected fitness. That's probably a topic I imagine we'll get into more later on when we talk about some of my favorite trades right now. But any sort of change that's impacting companies, it's all about identifying it early, if that makes sense.
Yeah, no, that makes complete sense. Yeah, that seems key. And actually, I guess to me, it's, strategy might be too limiting a word to put on it. It's almost an investment philosophy, I suppose. Actually, there's a lot I want to dig into. But first, and crucially, I suppose, for anyone that isn't aware of your work, I'm keen to understand what's influenced your career thus far and how you've made it to where you are today. So, as far as I'm aware, your career has been predominantly, up until this point at least, in the tech or software space, having worked for companies like Shopzilla and eCarList before co-founding TickerTags in 2013. So I imagine that's given you a great insight into product development and business strategy, and even what to look for in the businesses you're investing in. I mean, is that fair? Has that proved sort of relatively formative in terms of how you invest now?
Yeah, I kind of, my professional career since 1998 has been working at early stage companies, starting with a company called carsdirect.com back during the dot-com boom, to a company called BizRate, which today is called, Shopzilla. Mm-hmm. I don't know how many, they might have changed their name since then. I actually then spent 10 years helping build a company called eRewards Market Research, which is, acquired Research Now. And it's called something different now, but it's the world's largest research company, research panel company. I then actually helped a couple of my friends start a company called eCarList that we grew and sold to a publicly traded firm called DealerTrack, which is now part of Cox Automotive. And then I became, through this process, right, of working at early stage companies, every time you get a little bit bigger chunk of the company, and eventually you just kind of start your own, and then you start your own and sell that. Then you start investing in other people's companies, and that's kind of how it all starts. And before you know it, I'm now invested in 60 different early stage companies that are all private, and a lot of them I'm an advisor, consultant, and some of them I'm even an operating partner of. And we've been fortunate to take a few of them and sell them to publicly traded companies. So we have a few big wins. My most recent one was TickerTags, and that was a company that touches social arb investing. It was really taking social arb investing and bringing it to Wall Street. So we created a tech platform that essentially allowed hedge funds, quant funds, and investment banks like Bank of America and Jefferies to actually measure the frequency of mentions of word combinations across Twitter, so they could actually identify these anomalies in conversational data early. So it was really a way of institutionalizing the methodology, and we ended up selling that company to Jefferies. But yes, I think being intimately involved in business from an early stage, even at the enterprise level, enables you to understand, I would say, the marginal drivers of acceleration or the marginal drivers of success for a company or a sector. So those worlds really do merge.
Yeah, interesting. And I did have a question down here about how much kind of your experience at TickerTags and what you created there has influenced your current strategy. I mean, they seem to almost completely align. So essentially, is what you're doing now very much representative of the experience and the product you created at TickerTags?
Yeah. So what I'm doing now, TickerTags was really just a tool for my methodology, right? And it was a tool that could have been used by, just retail traders or institutions, but due to the high cost of purchasing data from Twitter and then managing hundreds of millions of tweets in real time and being able to graph them and extract insight from them, the price point of using that tool was really unreachable for retail investors, so it was geared towards institutions. I wouldn't necessarily say the tool itself or creating ticker tags and selling that company has changed the methodology, because it really just was a tool. But what it taught me, having spent 4.5 years of my life working, really closely with some of the best hedge funds and quant funds in the world, as well as some of the best sell-side analysts in the world, and really educating Wall Street about conversational data and how to interpret conversational data. What it taught me was that, because I had never worked on the institutional side of Wall Street, right? And I always thought behind the curtain, there were things that they knew that me as a retail trader, really, I was at a huge disadvantage. And I think a lot of retail traders feel that way. I ultimately realized that there was nothing going on the other side of the curtain. No disrespect, because probably some of the smartest people I've ever met in my life were, on Wall Street that I met over this 4.5-year period. And some of them are still very close friends. And a few of them are actually amazing at what they do, but most of them are not very good at what they do. And it's really not because they're not smart. It's an institutional problem because of the way Wall Street works. And it's really hard for individuals that work at that institutional level to really do things differently from the way they've been done for decades. And it's really hard for them to gain a true information edge or social edge, even using tool sets like ticker tags. So, the one takeaway was that the retail investor is not at a disadvantage. And in many ways, because of the flexibility a retail investor has, they have an advantage over institutional traders in Wall Street. And that's kind of what I took away from that experience.
Yeah, well, I'm sure I've mentioned to you before, but a lot of the people listening in will be retail investors. So that'll be comforting information and news for them as well, as they try and sort of gain alpha and seek their edge as they're investing in trading. And actually, that's probably a nice juncture to return to your strategy and kind of work out and listen to about what you do on your side of the fence. So firstly, starting with the theory before tackling how and what shape that takes in practice, is it all about detecting early change, as you said? And what I mean by that, I suppose, is it crucial to know and understand something before the rest of the market?
Yes. I mean, that's everything, right? So it is absolutely everything. My life, I probably spend somewhere between, 30 and 60 hours a week trying to surface investable opportunities by looking for change, right? So I spent a tremendous amount of time on Twitter, and there's various, I would, for lack of a better words, various keywords that I'm constantly checking to try to identify, change in consumer behavior, change in culture, change in product demand across various categories, changes in weather, right? I mean, literally any sort of change. Sometimes it's a matter of identifying the change months early. Sometimes it's identifying a change weeks or days early. And occasionally it could be identifying something in a matter of minutes earlier than the market. So that's really where everything starts. And without it, you really can't be a great social arb investor.
I've heard you sum up the investment process by which you work in 3 key questions. So first, you ask yourself whether the thing or the change you've spotted has the potential to majorly impact the company positively or negatively. Can you give us an example of that to make it more real for the people listening in?
Sure. So this is an example I love, actually. It's one of my favorite trades. A few years ago, there was a trend that was happening. It was happening globally with kids, and kids all out of nowhere started to make slime. And what I mean by slime is actual slime, right? So it became a big crafting trend for kids and moms to do with kids, to where they would create all kinds of different colored slime and different textured slime just to kind of play with at home. And it's something that I picked up on really early on. And that was just simply a change in behavior, in what kids like to do. Like, and the trend lasted for like over a year. It just happens to be that one of the primary ingredients for DIY slime, right? Do-it-yourself slime is white glue. And the world's largest manufacturer of white glue is Elmer's glue. I was able to surface that trend very early, and I connected the dots to Elmer's glue. And then when I started researching Elmer's glue, I realized that they were selling out, right, globally. So it became next to impossible to buy Elmer's glue. Well, Elmer's Glue is a subsidiary of Newell Brands, which is a publicly traded company, maybe better known, they used to be called Rubbermaid. Although Elmer's Glue is a really small part of that company, the company itself is a slow growth company. So even if Elmer's Glue was only 1 or 2%, and I think they were like 1 or 2% of the total company in terms of revenue, their revenue increasing by 50%, which is exactly what happened at Elmer's Glue, was able to have an outsized impact on the overall company and really move the needle for earnings for multiple quarters in a row. And what was amazing is that Newell Brand stock price, I think, went up 17 or 18% over the course of a couple quarters. It was a trade that I had, initiated. It was a levered trade. And I think I ended up making, I don't know, maybe close to 200% on my investment over a very short period of time. But that's a really interesting example where the whole world could have seen this, right? There were tens of millions, if not hundreds of millions of families globally where there were kids making this slime. How many were able to, make the connection between that and an ingredient of slime and the company that was investable based on that trend?
Yeah, interesting. Actually, I think that feeds into my next question. I mean, so as I understand it, the second step of this process is essentially recognizing whether the rest of the market already knows about the thing or the change you've noticed. So how do you get a sense of whether the market has already picked up on this?
That's a really important piece of the process, and it just might be one of the hardest parts of this social arb strategy. So what you want to look for is, in this case of, identifying, the DIY slime trend, you want to try to detect, does anyone else know about this that's in the investable market for Newell Brands, right? Do analysts know about it? Do the funds investing in it know about it? Do retail traders know about it? So you want to try to search all of the news, all of the analyst reports that you can, identify online. You obviously want to go read the quarterly earnings reports, the most recent quarterly earnings reports for the company. That's something that I recommend every investor do. And, through that process, obviously go on Twitter as well. Go on StockTwits, right? See what retail investors are saying. Go on sites like Seeking Alpha and read amateur analyst reports there. Is anybody talking about this, whether on the retail or institutional side, or even on the company side? So what I was able to do at one point during the trade was identify that even the company acknowledged this. They actually acknowledged it in their quarterly report by saying they were seeing an uptick in sales of Elmer's Glue due to this trend. And at the time, the trend was pretty early. So I was able to actually monitor the trend and see that it had grown substantially quarter over quarter. So if it was on management's radar in the prior quarter when the trend was barely a thing, it made intuitive sense that as that trend got exponentially larger, it was really going to become a big part of the story in the next quarter. Yet no analysts were talking about it. No retail traders were talking about it. I wasn't able to find anywhere where people were really discussing this actively as being a big thing that was happening, and that you should invest in Newell brands because of this trend. So I felt that there was still a pretty large information imbalance, and trying to really make that determination as a social arb trader is just something that you develop a gut instinct to over time. If you kind of see it mentioned in web boards and on Twitter and on StockTwits, and it's also being discussed in analyst reports, then you know what? It's probably too late. If it's not being discussed at all, you probably have a good opportunity to arb that social information. And if it's being discussed a little bit, you just have to make a determination for yourself.
Yeah, interesting. And I guess once you've done all that homework, you're confident that you've noticed this information imbalance, as you just said there. Based on the period that you think it will take for the market to learn about that information, an investor or trader should ask themselves, I guess, as this third key question, whether there is something else that could happen in that trade window that's more significant than what they've discovered. And I've heard you give some good examples of this as well. I wonder whether you could give us one of those, just again to make that sort of real for the listeners.
Yes. So, again, the concept is investing at an information imbalance and then, exiting at information parity. But you have to, make sure that not only is this information going to move the needle for the company, but that also there's not something else happening at the company that is more important than the information that you're trading. So, if you know that there's going to be a judgment on a major lawsuit or a major government regulation over the course of the period of time when you think your information is going to be disseminated to the market, and that government regulation or that class action lawsuit or anything else, right? If there's another product launch during that quarter and the whole world is looking to the success or failure of that product launch to determine whether or not that company should be valued higher or lower than where it is today, certainly that might be more important than some piece of information that you're trading on that company, right? So you just have to really make that determination. And it's really on an investment by investment basis. And there have been times in the past where I've made trades and I was correct in the information I was trading, but something else you weren't even aware of, such as a large fund that had been looking for an opportunity to exit a 10% position in the company, or maybe they were one of the largest shareholders in the company. They're looking to exit during your trade window, and that could really come to haunt you, right? So sometimes you're able to identify when there's something that's going on that's more important than the information you're trading. Sometimes you can't identify it. And that's just part of the risk profile of any trade. But it's something that as an investor, you need to be aware of, right? It's not just the information you're trading. What else is happening at the company that could trump the information you're trading?
Yeah, completely. And to get a sense of what this looks like in practice, if we start with your position sizes, I mean, how much of your portfolio are you risking on any one trade?
Yeah, I like to think of trades as being either low, medium, or high conviction. On a low conviction trade, I might be, if I'm just investing equity, I might be investing a couple percent of my portfolio. On a high conviction trade, I might be investing anywhere between 20% of my portfolio and 30% of my portfolio in an individual equity on a high conviction trade. And, there have been times in the past where I know this seems insane when I was much younger that I invested 100% of my portfolio in a single investment. I remember investing 100% of my portfolio in a company that everyone probably knows, Nintendo, back when they first released the Nintendo Wii. I don't know, maybe it was 2006, 2007. I was able to identify that the Wii was a real game changer, being at the E3 conference back then when it was first released and kind of seeing the way people interacted with that gaming set. It was kind of the first gaming set that had truly brought gaming outside of the box, right? So where you could really play sports in your living room and do all kinds of fun things. And it was a real game changer. I don't think the market appreciated it because they were so focused on one of the initial first-gen consoles for Sony, PlayStation and Xbox. And, and no one thought that this little weak-powered Nintendo Wii system, which was not nearly as advanced as the PlayStation or Xbox, could compete just because they had this, system that allowed you to hold controls in your hands and it could see you waving your arm when you're playing fake tennis, right? So sometimes if I have high conviction, I'll really invest quite a bit of my portfolio.
Yeah, and I guess we talked about that sort of extensive homework you're doing on these companies to give you that high conviction. I just wondered whether there was any sort of consistent metrics, and I know you're not obviously a fundamental investor, but whether there's anything that maybe is a bit of a smoking gun. If you see that stat or that metric, that gives you the inclination that maybe something's going on here and it's worthy of further investigation, or whether there's any sort of actionable insight there that we can pass on to the listeners.
No, I only look at three things really: the degree to which that information will move the needle for that company, and then also whether anything else is happening at that company could be more important than the information you're trading, of course, and then kind of what the trade window is for when you believe that information will be disseminated to the public, whether it's a quarterly earnings call or some other point at which you think that information will be surfaced to the market at large. I don't look at any fundamental information at all. I don't look at pricing. I try my best not to let that cloud the pure nature of the social arb strategy.
Yeah, that's interesting. And I guess following that, then it seems to me, at least, that the less sort of quantitative, the less sort of metric driven your approach, the harder it might be then to systemize it and replicate it and replicate that process at scale. What's your take on that?
Yeah, I mean, people always say, and that was the big issue with Wall Street embracing the methodology, right? They wanted something that could be replicated at scale. They wanted to be able to extend the methodology to hundreds of trades a year, right? And I just don't see this as being something that you could successfully extrapolate to hundreds of trades a year. Dozens of trades a year, potentially. For most individual investors, I think the concept of making one great social arb investment a year is plenty, right? Because it's hard. For me, yes, historically, I think over the 15-year window that I turned, tens of thousands into tens of millions. It's way more than 10 million now. It's well north of 30 million over the past 15 years. I generally have made anywhere between 2 and maybe at the very, very high end, 6 high conviction trades a year, but usually 2 or 3, right? So in some years, just 1. So why do people feel that they need to have a strategy that can be extrapolated over hundreds of trades a year, especially if you're a retail trader? It's not necessary for me. And certainly I've been able to turn tens of thousands to tens of millions. I have every intention of turning those tens of millions into hundreds of millions, if not more, over the course of the next decade or two. So I just don't think it's necessary, right, to be able to institutionalize the methodology. It is something that takes a lot of manual observation and a lot of manual interpretation. And there is a lot of interpretation. I could be looking at the same trade that you are in the same way, but have a very different interpretation as to the degree to which this information will impact this company, the degree to which this information is important, the degree to which other people have, looked at this information or not, right? How saturated is the information, right? How much is it? to what degree has it been disseminated already to the market? And what else is happening that could conflict with this trade? We could disagree on all three of those things, even though we're looking at the same information, right? And that's okay. That's just part of it.
Yeah, completely. And actually, I guess listening to this has kind of made me realize that another, I guess, really important element of the process and part of the philosophy, to use a grander term, is essentially to be truly unconstrained, to borrow an institutional term. You're not just non-asset class specific, for example, but you know, it seems that you take that step further by investing in private companies too, for example. I mean, is this something that you'd encourage other retail or self-directed investors to do?
I encourage everyone to engage in the investment community. I think it's extraordinarily important, especially for this next generation, who's really, there are a lot of things the next generation is looking to achieve. And unfortunately, I think a lot of those things they feel handcuffed that they could only achieve them through political means. And I think people underestimate the power of their pocketbook when it comes to the types of companies or sectors they invest in. You want an EV future, you can invest in EV companies, and to the degree that your investment works out or not is really determined on the degree to which your generation embraces EV. But if you feel like you're going to embrace EV, electronic vehicles, then invest in that sector. And the investment in and within itself, as we've seen with Tesla, sometimes can change the world, right? And could actually change that company's likelihood of being successful, right? And accelerate the EV movement. So a lot of the reason, really one of the only reasons why I started, our YouTube channel, our Dumb Money, and we have two YouTube channels, Dumb Money and Dumb Money Live, as well as our Discord group, is to democratize investing for the masses. I mean, I don't sell anything, right? Like, I don't sell programs and, I don't sell training. I just trade for myself. That's how I make my money. I think it's really, really important for people to get involved with investing. And it not only allows you the ability to be financially independent quicker in life, and regardless of what your career is or how well your career goes, but it also gives you the ability to really kind of, mold what the future looks like by controlling where your money goes.
Yeah, completely, actually. And it's that democratization and the dissemination of information that you are putting out via your two YouTube channels that really, to me anyway, gives it real authenticity. And I've got a couple of questions on Dumb Money explicitly or specifically in a couple of minutes. We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show. So I just wanted to finish this section on your strategy with two questions, really, and hopefully they're fairly simple. But the first is, what do you think your best, or to use a different word, favorite trade is thus far?
Okay, so my favorite trade was this year. I have so many favorite trades, by the way. But my favorite trade was probably this year, Peloton. Well, why? I've made more money off it than any other trade I've ever made. It's a trade that I've now made probably close to $4 million on just this year alone. And I love the trade. I love trades where the rest of the market just doesn't see it. I love spotting things when the rest of the market is just, really behind. They have the same information as you, but they refuse to believe it. And the Peloton trade started back in March, when obviously we're in the middle of a pandemic, and the market didn't realize that Peloton had stopped advertising and the impact that would have on their financials and their profitability. They were selling Peloton, so many of them. And I know Peloton is, a company that's pretty new to Europe, right? It's really big here in the US. They recently started selling them, I think, in Germany and think Germany and the UK. But Peloton was selling so many bikes they didn't have to advertise. And the knock against Peloton was always they have to spend so much money on advertising, they'll maybe never be profitable. So that was something that I caught on to very early. And it worked out really quite well for me because the market just didn't believe that an exercise bike company would ever grow to be as prominent as Peloton has grown to be. And it still continues to be, quite honestly, one of my favorite trades. And it's a company I still own quite a lot of stock in.
Okay, yeah, great. I was going to ask whether you've still got a position in Peloton. Yeah, that's really interesting. So if we flip it then, what's the worst trade, or again, if I rephrase slightly, the one that particularly stings?
Yeah. So I had a hedge fund for a very short window of time, like 90 days. Right around the same time I was starting Ticker Tags, I had to close the hedge fund because my Ticker Tags clients did not want me trading on my own data. They thought I would front run the data before they could see it. Right? But I had this huge track record. It took me a year to launch the fund. I had 24 limited partners, and I was really excited to get my first trade under my belt. And after 10 years of ridiculous returns, I think averaging 70 or 80% annualized returns in the market, I finally launched this fund. My first trade is a toy company called Jack Specific, and I was trading a toy called Snow Glow Elsa from the movie Frozen, and it was probably one of the best-selling toys in 2 decades of the toy industry. And Jack Specific, this tiny little toy company, manufactured the toy. The day of earnings, when the information got disseminated, and they had the best quarter in the company's history, the stock was trading up 35% pre-market. I was levered in the trade. I was set to make close to 150%, maybe 200% return on my investment. I was really proud of myself, so I worked really hard on the trade. The market opened and the stock immediately went from being up 30% to being even, and within a matter of minutes before I could even start to exit the trade, it was down 5%, 10%, 15%, 20%. Before you know it, the stock was down 25%. I didn't realize what had happened until I think about 6 or 7 weeks later, when I was able to see SEC documents showing that, and this is an example I talked about earlier, kind of hinted at earlier, the largest institutional owner of the stock, the fund that owned more of the stock than anyone else in the world, was selling into the strength. And as I would have never have known this, but they were looking for an opportunity to exit their position. And with all that strength that day going into that great earnings, they decide to dump their entire 10 or 11% ownership in the company in that single day. Something I could have never have known, but it still haunts me. And it was really quite embarrassing way to start off that fund.
Yeah, so not the best way to start. I could definitely imagine why that one stings.
But it shows that you just, no matter how hard you work, no matter how much information you have, and no matter how high your conviction is in the information you're trading, you never, ever, ever, there's no such thing as a sure thing. Even the information you're trading could be a sure thing, but there's always other elements that you will never be able to see that have potential to come in and adversely impact your trade. And that's something as an investor you need to always be aware of.
Yeah, for sure. Yeah, well, really solid advice for anyone listening in, I'm sure. And I mentioned it earlier, but I want to end the interview by talking about Dumb Money. I've just got a couple of questions about that YouTube channel, that business. You founded it in 2018, I believe, along with your friends Dave Hanson and Jordan McLain. For any of our listeners that are yet to tune in, what's it all about?
Yes, so we do. This is all brand new to us too. we now, it used to be we were usually doing startups, right? We were taking a camera around, showing you all the startups we were meeting with. So it was kind of like a live version of Shark Tank, but there was no stage, because when you invest in startup companies, you're not sitting on a stage where people are coming up pitching their ideas. You're out there in the real world, meeting people, driving around, taking meetings, hearing rumors about founders doing great things. And sometimes you'll be hanging out with a founder for months and months before you pull the trigger on that investment. So we kind of showed you the real guts of what it's like to be an early stage investor. And we took you on that journey with us. And I loved it. It was so much fun. And that was our, youtube.com/dumb money. That was our channel. And when the pandemic hit, we were no longer able to do that stuff because we're stuck in our house for the last 8 months. So we launched Dumb Money Live, which is youtube.com/dumb money live. And that was a channel all about us trading stocks. And we do both now. Even the old Dumb Money channel is really more about stock trading than early stage investing because we haven't gotten back out there yet to the startup world because we're still stuck in our homes. But Dumb Money Live is really us just doing what we do every day, which is talking to each other about the things that we're seeing, the opportunities in social arb investing, the changes that we're seeing happening in the world and how we're connecting that change to investable opportunities. It's so much fun. We tape it twice a week. We're usually on for an hour or two. And it's just, us talking. And you really get to see inside the mindset of a social arb investor. And we really share just about all of our medium and high conviction, some even of our low conviction trades. We share them with our community in real time. We're not advisors, right? We're not financial advisors. We don't give financial advice. We just kind of let you look into our window of how we see the world, how we surface investments, how we vet those investments. And then we kind of let you watch as those investments unfold, either positively or negatively. And listen, this has been an insane year for us, right? So, my portfolio has grown just this year from, 7 million to well over 20 million. And if you were watching Dumb Money Live, you've gotten to experience that growth in real time, starting with when we shorted the stock market back in March because we saw this pandemic surfacing, and the rest of the market was clueless to it for the most part because of all the noise, right? And we saw through the noise. We had a thesis of how it would impact the global economic world and financial markets, and we put a tremendous amount of money risk shorting the market, in a levered way, and it worked out quite well for us. And at the same time, I was seeing all of these other stocks that, quite honestly, should do well in a pandemic, like Amazon and Peloton and Shopify. And there were dozens and dozens of companies. I said, wait a second, why are they down 30, 40%? These companies will do nothing but benefit from this situation. And sure enough, I went long in all these companies in a levered way. And a few weeks later, the market started to realize that these companies were not going to be harmed. They were going to do just fine. And so if you ask me, hey, how did you triple your portfolio size this year? That's how I did it, right? And just thinking about things like, okay, how are consumers behaving? Well, guess what? Everyone's really embracing the outdoors this summer. They're going camping, right? They're going canoeing. They're buying all-terrain vehicles. They're buying boats. They're buying jet skis, right? I mean, this was pretty evident, but the market didn't see it until it actually already happened in the summer. So, all these stocks that are involved with the great outdoors, and we did an episode called The Great Outdoors, where we literally did nothing but talk about all the companies that were going to benefit from that trend. And sure enough, they were some of the biggest winners this summer. So that's what we do. We've built this amazing community. We have a Discord channel, dumbmoney.com/Discord, where our community does what we do now. We have, 3, 4, 5,000 people who are social arb investors. And quite honestly, I'm getting some of my best trades now from the community. So we really have built this collaborative space where this whole notion of being a social arb investor is a thing. And it's really kind of one big family, quite honestly. And I love it because anybody can do what we do. And we are truly democratizing this concept of just being able to detect change early and connect that change to investable opportunities. We share it through our YouTube channel. We collaborate on Discord. And, we don't know where it's going, but we're having a lot of fun with it. I think our community is as well.
Yeah, I mean, it definitely comes across that way. It really is a fascinating watch, and I definitely recommend our listeners tune in. I mean, for me, the lifestyle focus, and even in the pandemic, that just idea that you're giving every second, good or bad, to the viewer is something that makes it, I guess, really authentic, and it really comes across well. So I'm sure a lot of our listeners will tune in. So if I can just finish, we typically ask, I think, all of our guests so far, quick fire questions. So there's 5 of them. And the idea is that you can answer in as little as 1 sentence or even 1 word. So the first of those is, what, in your opinion, is the top mistake investors make?
Getting caught up in market noise, watching financial news and letting that noise impact your investments. And worst part of all is, letting the noise and letting other investors, quote, professional institutional research analysts and investors, change your mind about something that you were excited about, right? Believe in yourself, believe in your own research. They don't really know a lot more than you do, and more often than not, they know less than you do. So don't let them cloud your mind as an investor.
Yeah, completely. Okay, so second question, what's your favorite stock at the moment?
Well, I think I mentioned this earlier. I really do love the Peloton, and the reason why I love it is, I think it sounds a little cheesy, but I think it can be the Apple of connected fitness. It can be the Lululemon of connected fitness. I believe connected fitness, if you move forward 10, 20, 30 years, I think we think about fitness the same way we think about having big TVs in our house. It's just something that everybody does. I'm not saying that gyms are going away forever, but I think gyms are getting smaller in time, because I think you don't need to go to a gym to feel connected. And I think fitness is a category that just keeps growing, and Peloton is definitely the market incumbent and the leader. And I think they have a bright future ahead of them, and I'm really excited about the future of Peloton. And it's one of those stocks I think I'm going to be in for a very long time.
Yeah, completely agree. Okay, so question 3, and this is a tough one. What is the most memorable moment from your career to date?
I love it when I get things right that are not a small stock or a medium stock, a mid-sized stock, but when I get things right that are maybe some of the biggest, most covered stocks in the world, and the entire world missed it and got it wrong, right? I would say there's 2 of those situations. One is with Apple. Very, very early on when the iPhone first came out and all the world's analysts, I wrote a book called Laughing at Wall Street, and I dedicated a whole chapter of that book, Laughing at Wall Street, to Apple and this trade. Because every analyst in the world pretty much said, they don't have a keyboard, it'll never work. Apple's not a phone company, they don't know what they're doing. They really missed what it was like to hold an iPhone in your hand for the first time. Wall Street was so disconnected from culture, so disconnected from humanity, that they didn't understand the impact that single device was going to have on our culture and our world over the coming decade. And that was an investment I'm really proud of. I had another one in a company called Netflix, also one of the most covered companies in the world. A few years ago, in a quarter when all of Wall Street said they were going to miss earnings, I came out, when I was at Ticker Tags, we put out a report that essentially said, no, we think they might have one of the best earnings quarters ever because of a show called Stranger Things. And, we were able to look at social data and identify that there had never been a show in the history of Netflix that had driven as much social conversation as this show Stranger Things. And the one thing that we knew about Netflix was when people talk about a show, that results in people subscribing to Netflix. And sure enough, the stock was up 20% on earnings that day. Wall Street was completely shocked. And we were the only data shop in the world that had come out that quarter, and really with a strong conviction call on Netflix. So I like it when we get it right and everybody else gets it wrong. It makes me realize that we're really onto something with social arb, a strategy.
Yeah, I completely get why those are potentially the most satisfying trades. So question 4, and the penultimate question, a top tip for your younger self.
Yeah, go bigger. Go even bigger on my highest conviction trades. I think even Warren Buffett said that, he really only had 10 trades throughout his 45, 50-year career that made the vast majority of his money for him. I'm in the same boat. Just a handful of my biggest trades contributed to most of my gains over the past 15 years. And if I could do it all again, even though I went pretty big on those trades, I would go even bigger. You never know. You might only get 1 or 2 or 3 big trades when you're right and everyone else just doesn't see it. And when that happens, I go bigger. But it is important that I go bigger with money that I'm willing to risk. And it's really important to separate what I call risk money from the money that pays for your kids' college education, right? Or the money that you need to pay your bills. So while I say yes, go big, it's important to bucket your money out. I'm not a financial advisor, but I bucket my money differently for trading. But of the money I have for trading and taking risk with, when I see something I really like and I'm high conviction, I need to go in big on it and lever myself.
Yeah, okay, that's great. And final question then, and it's something on Opto we're really into. We're all about speaking to the people and the companies that are outperforming the majority, outperforming the wider market. So in your opinion, and I guess if you could sum it up in one word, or if you could highlight one thing, what is your biggest source of alpha, do you think?
My biggest source of alpha would be people, conversations. Just observing the world's conversations. It's the one area that I focus on most. I use data sources like Google Trends, and I love it. But Google's Trends is a hard data source, meaning it's black and white, and there's not a tremendous amount of interpretation. With social conversations, there are a lot of ways to interpret the data, and that's what I love, because everyone could be looking at the same data as me, but I can gain an edge on everyone else because I feel like I'm the best interpreting that data and identifying where there's an anomaly or where there's a true change in the way people are speaking about a subject matter or about a brand or about a company's products. And that's where I find the most alpha.
Okay, great. Yeah, well, thank you very much, Chris. I'll let you go. You've already been really generous with your time, but just thanks so much for coming on the podcast, and hopefully we can speak again soon.
Absolutely. It was a lot of fun.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.